Funding for local broadcast of Wall Street Week has been provided by a grant from Bidwell and Company, in the business of helping you keep more of the money your investments earn, and by This Week magazine, which features Louis Rukeyser's column in each issue. This Week magazine, there's something in it for you.
Wall Street Week with Louis Rukeyser is made possible by the financial support of viewers like you. By the Travelers, over 40 million Americans benefit from our insurance, investment services, and managed health care. The Travelers. By Ameritech, Ameritech's Bell Companies and Ameritech's other communications businesses, creating better ways to communicate here and around the world. And by Prudential Securities, the knowledge and resources you need to help make intelligent investments rock solid, market wise. Produced Friday, April 5. Our panelists are Michael Holland, Bernadette Murphy, and William Waters. Tonight's special guest is Samuel Eisenstadt, Research Chairman, the Value Line Investment Survey.
Good evening, I'm Louis Rukeyser. This is Wall Street Week. Welcome back. Well, this was the week of April Fool's Day, and the news seemed to be tailored to match. Who would seriously have believed, for example, that in what is supposed to be the real world, in one single week in the spring of 1991, Russia would be flirting with the idea of leaving the Soviet Union, Western Europe, that notorious home of peaceniks and appeasers, would be seeking to stiffen America's resolve to finish the military job in the Persian Gulf. And at the Federal Reserve Board, Chairman Alan Greenspan, who resolutely squashed the nation's money supply for 3 harshly tight years, was under fire for being, I kid you not, too soft on inflation. It was topsy-turvy time, a week of bizarre turnabouts that seemed less like the news than like a special edition of Mad Magazine. The situation at the Fed may have been the biggest parody of all. It seems that the central bank's highly belated recognition that economic growth was being squelched was not enthusiastically supported by all the board members. And that Dr. Greenspan, a soft-spoken chap who sometimes makes Jacqueline Onassis sound like a shouter, was not able to crack the whip as effectively as some of the celebrated autocrats who preceded him in the chairmanship. Or perhaps the dissidents merely felt that to go overnight from excessive tightness to excessive ease, with no intervening stop at stability, was just a tad too abrupt, even if it was entirely in keeping with every hysterical tradition of the Federal Reserve Board. The bottom line was that there was no bottom line, at least for the moment. The Fed seemed paralyzed by internal debate, thereby frustrating those economists and investors who had hoped that every piece of sour economic news would be followed by another cut in interest rates. They got the sour economic news. Unemployment, as expected, is still going up and will probably continue to do so. Factory orders and construction spending are still going down, albeit at slower rates. And a survey by the Fed itself disclosed the apparently astonishing news that it's still pretty tough to get a loan in these United States. Never mind that sales of new homes surged in February, or that the government's own index of leading economic indicators scored its fattest monthly gain in more than 2.5 years. There was plainly a recession going on right now, and the Fed, just as plainly, was too immobilized to do anything more about it right now. In the end, that's not likely to matter much. The thrust of previous easing hasn't yet fully worked its way through the economy, and there were abundant signs that recovery is on the way. But the Fed's failure to respond with immediate further easing, say one more juicy cut in its influential discount rate, tempted some institutional profit-taking, which in turn brought in the felons of program trading, and the Dow Jones Industrials once more were turned back from the 3,000 barrier. It remains to be seen, of course, who the real April Fools will be. We tonight will talk with a man who is nobody's fool, the fellow who oversees some of the most market-moving numbers in Wall Street. But first, let's check out the April foolishness in the financial markets. The Dow Jones Industrial Average had its third best day of the year on Tuesday, a 64-point advance, amid growing signs that reports of the economy's death had been exaggerated. But concern about the Fed's internal stalemate helped spoil the mood later in the week, and the blue chip index finished with a 17-point loss at 2896.78. But the broader market once again outpaced the Dow, as it has tended to do lately, and the New York, S&P, and over-the-counter composites all moved during the week to all-time highs. And our elves insist that it isn't over yet, with the 10 top technical analysts netting out to a +5 buy signal for the third straight week. While the Fed's failure to slash short-term interest rates further disappointed some stock traders, there was an opposite reaction in the bond market, which might have been getting a bit edgy about the prospect of too much too soon. And bonds continued their recent advance. Gold and silver were up a notch, the dollar down a bit, but the most significant financial news of the week may have come from Georgia State University, where scientists said they believed they had found some chimps who could understand English. It's not known whether any of them have yet been nominated for the Federal Reserve Board. Bernadette Murphy, no one could accuse you of monkey see, monkey does. You're still one of only 2 of our 10 chief elves who have continued to be bearish on the stock market. How come?
Lou, it's the 3,000 level has been a bit of a barrier for the market, as you've mentioned. We tried to get through there last July, and here we are 9 months later, and we still haven't broken through the barrier. I think that to turn me positive on the market, if we went through that resistance area, the 3,000, 3,100 area to cover the intradays, with some of the vigor that we showed earlier in the first quarter, I think then I'd have to say we really have something unusual here.
As you know, Bernadette, I worship at the feet of technical analysis, and one of the things you have instructed in me over the years was that the performance of the broader market is key. Clearly, the broader market's now outpacing the Dow. Mm-hmm. Is that a strong positive for you?
Well, I think it is a strong positive. I'm glad to see it, and I think it'll be a characteristic of the market in 1991. But now I must turn back to being the technician and say the volume of the over-the-counter market as a percentage of New York Stock Exchange stocks is very high, and that's usually a warning sign in the market that we might get a retracement.
So your instinct is still that we're late in the day in the bull market?
Yes, we're still in the bull market that started in 1982, and it's an aging bull market, and I think that we'll probably be facing a little bit more of a shakeout before we go on to another bull leg.
Let me turn to the ageless Bill Waters and see if he agrees with that.
I agree with Bernadette in the short term, Lou. I think that this market has gotten a little tired from the run-up in the first quarter. Institutional cash has been used up a lot because a lot of institutions missed the market and had to start in the second quarter. Individuals have been very enthusiastic. The breadth is very positive. So I think we'll have a pause, and I think we'll see a trading range from, say, up or down 100 points on the Dow from here for the next, say, month and a half. But I think the momentum longer term is there. And I think late May has always been a launching pad month for the market, and I think we'll see medium term a breakthrough 3,100 and then a bit of a run on the upside. Individuals today only own about 16% of their assets in equities, and that's very close to historic lows, and so there's still a lot of room to go in my judgment.
Why do you think individuals have such a low ownership of common stocks?
Because since 1987, it's been a lousy market until the early part of this year, and now people are coming back. Witness the action in the lower price stocks.
Now, Bill, you said that you thought we'd go beyond 3,100. You didn't put a number on it, and I'm not asking you to put an exact number on it, but there seems to be a consensus that we might get a little beyond that, but not much beyond. Are you saying that we'd get, say, over 3,500?
I don't think we get to 3,500 in this move, Lou, but I think in the long term we could. But I say, 3,150, 3,200 would be the tops in the medium term.
It would be all right compared to
today's
very
much all right.
Mike Collin, what's your view?
Lou, I think, as Bill said, we have a chance to go on to new highs. We're getting to levels now where there's some danger in the market, but this has a feel of the 1960s to it, where you have a bad economic backdrop and yet a rising stock market due to rising multiples.
Now, when in the 60s do you mean? There were periods in the early 60s when the market advanced strongly, and then it kind of topped out in the late 60s.
Yeah, we're talking about the mid-60s, where you had a period of time where the economy was rather punk, and yet stock multiples, the PE multiples, moved up.
On an inflation-adjusted basis, we hit the all-time high in 1966.
Right.
Do you think we're going to get back to a comparable level?
I think we have a chance that we're in the early stages of another bull market move, coming off the bear market move that ended in the late autumn.
So you think, while it may not happen tomorrow, that later this year will be substantially higher?
Yes, sir.
Well, we shall see. In any event, panelists, it is time now to bring some April showers of wealth to our viewers. Bernadette Murphy, a number of viewers would like to use their home computers to compete with you professional technicians. They are offered a bewildering array of financial software programs, so for the benefit of Charles Smith of Monterey, California, and many others. Can you tell us whether there are any computer programs for technical market analysts that you would recommend?
There are three that I'd like to mention. One is Telescan in Houston, Texas, and it has a very fine introduction to the use of a computer for technical analysis, and it has a very good database, and it does have some flexible pricing packages. The second is Metastock, which is produced by Equus International in Salt Lake City. It's a little step further than Telescan, and it also has an opportunity for a person to use their own data. The third is Computrack, who's an old-timer in the business, and their programs have a lot of bells and whistles on them. It's quite elaborate, and they're located in New Orleans. I'd suggest that they contact the companies because many of them have demonstration discs, demo discs, that'll show them what their programs can do on their own PCs.
No guarantees on the results, though.
No.
Bill Waters, Charles Breckheimer of Asheville, North Carolina, is curious about the amount of money spent by companies in publishing their annual reports to stockholders. In his words, virtually all these reports could be put on plain paper, needing only a graph now and then. Instead, most corporations lean toward techniques more suitable to Vogue or Smithsonian magazines. And they're full of photos of industrious workers and fat executives giving an obviously posed, steely look, evidently meant to convey confidence. My question is why? Who are they trying to impress? Not this stockholder. I'm only impressed with the bottom line, which shows up nicely on plain white recycled paper, unquote. You agree with him?
Well, I agree with him on the recycled paper. We use it for our report. I also agree with him that fat earnings are better than fat executives in an annual report, Lou. But the annual report is more than for just the analysts. You and I read, and Mr. Breckheimer read the numbers. But it's a marketing document designed to induce stockholders to become customers. It's a recruiting document designed to induce students to become employees. And it's a media document designed to create a good image for the company in the press. So there's a lot of constituencies out there, and I think annual reports, and it's now the annual report season, are here to stay in dressed up form.
All righty, Mike Collin, now that spring is here, Alan Hildebrandt of Logansport, Indiana, says his mailbox is full of thick seed catalogs. He wonders whether the companies themselves might be a better investment than the seeds. What's your view?
Lou, I think he's got a good idea. There are two leading companies, Pioneer Hybrid and a company called DeKalb Genetics. Each of them has outstanding management and terrific R&D. There's some near-term problems, however, and they include decreased planting intention by farmers. So while the longer-term investment potential may be there, I think the growth potential for Mr. Hildebrandt might be in the seeds rather than the company stocks.
Are you a gardener?
Yes.
You are? Well, we can sell some to you. All right, if you would like to develop a financial green thumb, our Johnny and Jane Appleseeds would be delighted to help you grow some fancy stalks and beans. So if you've reached the point where you'd rather have Jack than the beanstalks, send your best cultivated money questions to us here at Wall Street Week, Owings Mills, Maryland, 21117. That's Wall Street Week, Owings Mills, Maryland, 21117, where there is never a shortage of fertilizer. Now, before we meet tonight's special guest, the research chairman of what is perhaps the most widely watched stock ranking system in the business, let's see how that system works as we go for a ride on the Value Line. Value Line each week breaks down the 1,700 stocks it follows into 5 categories. 100 stocks are rated 1, which means they're expected to outpace all the others over the next 12 months. 300 stocks get a 2, which signals the expectation of above-average performance. The largest group, 900 stocks, are ranked 3 for average performance. 300 get a 4, which means Value Line expects them to perform below average in the next year, and 100 are tagged with a 5, signifying the poorest outlook. Over the 26 years that Value Line has been issuing these rankings, the system has worked remarkably well. Group 1 stocks have risen a whopping 15,641%, while stocks rated 2 were up 1,334%, 3s up 99%, 4s down 65%, and 5s down 98%. In each case, this calculation assumes that you changed your portfolio every time Value Line changed its weekly rankings. The comparative ratings have also stood up over the past 5 years, when the 1s were up 63%, the 2s 53%, the 3s down 6%, the 4s down 37%, and the 5s down 72%. Last year, when all stock groups took losses, showed only one mild divergence. Stocks rated 1 with a 10.4% loss actually fared more poorly than those rated 2. But from there on down, the comparative group ratings held up. How does Value Line make these weekly judgments, and what stocks does it like most right now? For some answers, let's go over now and meet tonight's special guest, Samuel Eisenstadt. Sam, welcome. We're very pleased you could be with us tonight.
Pleased to meet you.
A favorite guest of this program before his death 4 years ago at a youthful 86 was Arnold Bernhard, who founded Value Line 6 decades ago and built it into the most widely circulated of all investment services. Samuel Eisenstadt has been with Value Line since 1946, and he is now its research chairman and director of statistical research. Sam, how do you decide what rating to assign to a particular stock?
Well, the elements that go into making a Group 1 stock, for example, or any of the ranks, are an examination of a 10-year record of relative earnings meaning relative to the market, a 10-year record of relative prices, a measure of recent price momentum, essentially a technical factor, a measure of recent earnings momentum, earnings latest quarter vis-a-vis the same quarter a year ago, and finally a measure of earnings surprise, the degree to which market expectation is surprised by the actual report.
Realistically, no one out there is going to be able to change every time you change. To change every week, you'd be eaten alive by commissions, for starters.
Absolutely.
So how should people use these ratings?
Well, we recommend at Value Line that investors buy Group 1 stocks, hold them as 2s, possibly even hold them as 3s. As long as you avoid 4s and 5s, you're almost surely going to do better than the averages over a long period of time.
So I buy it when it's a 1, you demote it to a 2, I hang in there, you demote it to a 3, I say, darn it, but I hang in there. But unless you make it a 4 or 5, you think I can stick with it?
For more aggressive ones, we would even suggest once it goes to a 3, which is an average performance, switch out of that and find a Group 1.
What's the theory behind always having the same number in each group?
Well, the theory behind that is it really starts with the assumption that the market is unpredictable. And if that's the case, at every level of the market, there are always good values and bad values, and the ranking system tries to detect those.
Even with 100 1s, you've got to have some favorites. What are your 1 pluses right now?
Well, these are not 1 pluses, but these are stocks.
You brought a little list.
I'm not going to read 100, so let's not get frightened. And among those we like, and these are in alphabetical, not sequential order, first we like First Financial Management. It's a data processing company to financial institutions. We like Forest Labs, ethical and non-prescription drugs. We like Home Depot, building supplies, home improvement. We like Medtronics, implantable biomedical devices. We like PepsiCo, Philip Morris, and Walgreens. Now, none of these are surprises. The market likes them too, except that we think these will continue to outperform the market.
In addition to rating stocks on their expected performance, as you see it, you also rate them for safety.
That's right.
How important is that factor?
Well, it's a guide to subscribers so that they can decide how much risk they want to take. These safety grades have worked out very well over the years. In declining markets, the Group 5 safeties have been by far the weakest stocks. And it's tailor-made so that the investor can pick timeliness ranks and then pick them within a framework of safety that he can live with, that he can sleep with.
Do you know what the safety rankings of the stocks you've mentioned are?
By and large, they're high.
Now, in addition to ranking stocks against themselves, you also do some forecasting of the market in general.
That's right.
What are you looking for now?
In recent years, we've developed an asset allocation model. In terms of your elves that I saw on the screen before, I dare say Value Line would fall in the middle. We'd be neutral at this stage. Our market model is currently recommending an 80 to 90% invested position, and judging from the recent numbers that have come in, that number is headed south. So I would say it's a period to be cautious. We see for the S&P 500, for example, a gain on the order of perhaps 5 or 6% price only over the next 6 months.
The elves are supposed to be predicting the next 6 months.
Well,
so that would make you a mild plus. Is that right?
Very mild plus. Possible.
Heading south plus.
Heading south.
What are the things that are worrying you? Why are you heading south?
Well, the elements that go into the model are interest rates, of course, short-term rates, long-term rates. We look at free reserves. We look at the dividend yield of the market, which has come down, of course, with the current rise. There are 11 variables in all that go into this, and some of them are combinations of variables. Some of these are proprietary, but the fact that interest rates have ceased going down, that have stabilized at a somewhat higher level, the fact that free reserves are coming in at a lower level, much lower than they were in the early months of the year, and the fact that the market itself has had a substantial rise during this period, these three factors in themselves tend to depress the model.
Let me bring in three of our own ones, starting with Bernadette Murphy.
Sam, you mentioned that you have a technical ranking. Have you always had that? And you said it was price momentum. Would you explain what you mean by that?
The technical rank we introduced into the survey, I think it's about 5 years ago. We had it internally before that. And it's essentially a relative strength approach. Now, everybody uses relative strength in the street. But I think Value Line's use of it is unique in that it starts with the assumption that we don't know what past relative strengths to look at. So we put a lot of them in over the past year, and we asked the computer to tell us what should we look at. And it does this, and it does this reasonably well.
Sam, in addition to the 5 groups, you also have formulated at Value Line 7 rules for successful investing. We haven't got time for all 7, but what are the 1 or 2 of those that you think are the most important to our viewers?
Well, obviously, you want to diversify. Well, I would say diversify in Group 1 and Group 2 stocks. I think if you buy a representative sample of those over the years and stick with that, that you'd come out way ahead of the market, as you could see from the statistical results.
Sam, Value Line manages some mutual funds based on your quantitative system. When would you recommend for the viewers to buy the individual stocks managed by the system or through the mutual funds?
Well, it depends. I would say for small investors with a relatively modest amount of money, where they can't diversify sufficiently among the 1s and 2s, that they use a mutual fund that does it for them. And we do. The policy we outlined here are followed in the Value Line funds. We practice what we preach. We buy 1s, we buy 2s, we kick them out as soon as they go to 3s, and we replace them with 1s. So we're doing what he should be doing for himself.
Sam, we only have a minute or so left. There's a lot of people with pretty high IQs, many of them on college payrolls, who say you're wasting your time and our time, that nobody can pick which stocks are going to outperform others. They call it the efficient market theory. What's your response to these fellows?
Look at our results. And as a matter of fact, I've had on occasion debated with efficient market people and brought that argument to them. If markets are efficient, how can we possibly get the results we get?
What do they say?
They don't have they call the value line ranking system an anomaly, an enigma, and perhaps some even worse things that I don't know. But I've never gotten a satisfactory answer for that.
One other quick question. The value line index of those 1,700 stocks is often thought of as a proxy for the broader market, including smaller stocks. We talked about smaller stocks doing better. Do you see a sea change here?
It's a difficult period to judge that in, because the small stocks were very strong in the first quarter of the year. And as a matter of fact, they started early. In the first quarter, typically the small stocks act well because that incorporates the January effect, which I'm sure you've heard of before. Some of that came in this time and came in with a vengeance because these stocks had been decimated last year in the market decline.
We're just about out of time. You say we have to wait and see whether this first quarter's results continue.
No, I think the length of this rise and the duration of it would argue that there is a change for the better.
Thanks very much, Samuel Eisenstadt. Thanks to our panelists. Hope you'll be back with us again next week. Then we'll look at one of the most troubled parts of the American dream, the family home, and what it's going to be worth tomorrow. My guest, Gregory Nezma, is a top expert on the housing industry. We'll be asking him about the outlook for investors in other people's construction as well as their own. Meanwhile, this has been Wall Street Week. I'm Louis Rukeyser. Good night.
Wall Street Week with Louis Rukeyser has been made possible by the financial support of viewers like you. By The Travelers, providing American business with insurance, investment services, and managed health care. The Travelers. By Ameritech, Ameritech's Bell Companies and Ameritech's other communications businesses, creating better ways to communicate here and around the world. And by Prudential Securities, the knowledge and resources you need to help make intelligent investments, rock solid, market wise. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland.
Things normally run pretty